Welcome to Infinite Wealth Strategy. My name is Anthony Navoa, and I'm going to be showing you why the wealthy and the banks use this asset. There's over 3,000 banks nationwide that have reported using this asset and put it on their filings. They have over $200 billion sitting in this asset alone, as well as Nike, JCPenney, Walt Disney, Walmart, and many others utilizing it. Most people don't know. And I think that's just because school doesn't teach this. They don't show you your different options that you could be doing with your money for either retirement or for just overall wealth. Now, what makes this so good is that you get guaranteed interest, annual dividends that grow on a tax free basis, and they're not tied to the market. This is just a return of investment from the insurance company. Because just like banks, insurance companies invest money the same way they do. Now, what's the big difference? What does a bank give you when they invest the money? You get nothing or a very, very low percentage. So, this is why becoming your own bank can be one of the most profitable things you can learn because your money is going to grow with guaranteed and you have peace of mind there. And the insurance company is going to give you your cut, not like the banks. So, another cool thing about this is that the money's liquid and it's not locked away. So, you can use it whenever you want throughout your life. So, instead of borrowing money and paying interest to someone else, you can use your own money while still earning interest on it. And that's what makes this even more powerful. It's just putting you in control. So, what is the asset? The asset is a specially structured whole life dividend paying policy. You see, not all life insurance policies are built the same. Most of them, the one you're probably even familiar with, is the one that's built for only death benefit. And that's called the death benefit play, where they put all the money into the base. So, what makes this especially structured or structured differently or designed differently is the fact that the money is going to be put into cash value where it's liquid, guaranteed interest is going to be earned, annual dividends on a tax free basis. And the best part about it is that you actually do get a death benefit with it, but it's very small. But just like how the cash grows in your savings account, which is what I like to call it because that's what it is, the death benefit grows too. So you end up having a really, really good lump sum for your family when the time comes. So instead of having your money sitting around in a bank account of yours that's not earning anything, not being put to work, or putting money aside for tax withholdings that again don't earn any money, or putting it into HSA, or putting so much into a 401 or Roth that's locked away. What happens when you channel your money into this? So that's the first thing you need to establish. It's not about putting all your money into it, but it's about putting 5 to 15% to pay yourself first, to save money, and to put money aside for either future investments or for retirement. So once you've established that number and say, what the hell, I got 30K sitting in my bank, not doing anything, you can also use that to accelerate the compounding. Within the first year, you're able to put a lump sum, which can really, really help on the earnings of the compounding effect. Now, if you guys don't know, one of the brightest, or if not the brightest person on earth said this. Albert Einstein said, "He who understands it earns it, and he who doesn't pays it." He calls it the eighth wonder of the world. So once you really know what compounding is, then you know what you can have over time. And the thing is, I mean, you're going to be putting your money into something anyways. You're going to be putting your money into a bank anyways, or one of these other accounts if you are planning for the future. So might as well consider putting it in this where you have control, where you have access, and where you know it's going to grow. And that's peace of mind for you. So for this example, we're going to say this person has $40,000 that they said, you know what? I have this sitting in my bank account, not earning or working for me, so might as well put it into my own banking system. So they're going to be doing a lump sum payment in the first year for $40,000. And this person also said, you know what? I have $20,000 that I usually put in my bank account and don't touch year after year after year. That's their savings contribution. That's what they want to pay themselves first. And this person wants to do an annual $20,000 into their savings account. So for this example, we're going to be using Emma Watson. I wanted to use a 30-year-old that wanted to put in a lump sum of $40,000 and save $20,000 into their savings account, or again, their savings account on steroids, because that's what this is. This is Emma Watson, age 30, as you can see, standard non-tobacco, and 20,000 annual payments going in. As you can see, there's 60,000 going in, and that's where you find it here in total premium. And that is in year one, the first year of the policy being open, because of that lump sum and the 20K contributions to the savings. Full cash value, and that's what's available immediately. 80% is going to be available, or more is going to be available for Emma. And that's where liquidity comes in. That's where the guaranteed interest annual dividends are going to be earned. And the reason why it's 80% is because you can only put up to 80% into cash value without causing a MEC or any tax implications. But as you can see over time, in the cash value, every single year, that number is just growing and growing and growing and growing and growing and growing because of guaranteed interest and annual dividends compounding tax-free. Another amazing thing about this is that the death benefit, like I said, or the estate plan is also growing for Emma and her family. So let's check that out. Let's see what's happening. As you can see here on the death benefit, look at this amount and look how it even continues to grow and grow and grow and grow, because you don't get that anywhere else. So check out how this looks. Again, we have the cash value here on the right hand side, and it's growing throughout the years. Look at this. It's just straight compounding through guaranteed interest, annual dividends on a tax-free basis. And the beauty is that, year 5, money's available. You can use that for whatever you need. Year 6, year 2, it doesn't matter what year it is, this money is going to remain available for you because it's your money. And the insurance company understands this. It's not locked away. So let's see how the retirement income looks like. For this example, I set it up so that the contributions to the savings stops at 66. And you see it here, age 66. Look at the premium outlay. This is what's telling us how much money is going into the policy. It stops here. I also put it to cut back from 61 to 65, as you see here. But the most important thing is by 66, Emma Watson said, you know what? I'm hanging the boots. I don't want to be working anymore. I want to retire. And at this point, you see the income start. She's going to start withdrawing income. And this is going to be $120,000 tax-free for the years to come. And that's taxed free. By any year, she wants to just say, I have enough in my account from the last year. I don't want to do it this year. Let's say 39 to 40. She doesn't want to do it. She doesn't have to. It's your money. You decide what you want to do with it, okay? And you can see on the right hand side here, total death benefit, or estate plan, I like to call it. Look how much money is available for a family just in case anything happens during this time. during the time she's older, right? You're more likely for complications to happen at this age. But guess what? It's also going to have the greatest outcome for your family. So you leave them in a way better place. So 120,000 coming out tax free year after year after year after year. And this is going to last all the way up to 91, where it actually cuts back to 32,000 tax free. And even then, if you see on the right hand side, there's still money to be left for the family just in case anything happens. You still take care of them. So, how much money were we able to withdraw during retirement, right? That's the big question. And how much did we put in? This is the cumulative premium outlay, shows you exactly how much went in throughout the span. And again, 66 it stopped. As you see here, $690,500 is what went in. So how much were we able to get out for retirement? Let's pull up the calculator and see what's going on. So for 25 years, Emma Watson here was able to pull out $120,000 tax free year after year after year. That ends up being $3 million tax free. Do you see why this is such an amazing tool? You're already parking your money in some place where it's not working for you. You're not earning anything for putting it there. But if you channel it through this, guess what? $3 million tax free by the time of retirement. That's why the wealthy are using it. That's why these corporations use it. That's why the banks are using it. And you can have this in your life too. So 3 million by 90, and that's not even including the 32,000. So it's actually 3,032,000 tax free for retirement income. And let's say by 100 something happens to you, right? Because we don't live forever. That's still 467,000 tax free going to your family. So you're really ending up with, that's a lot of money that's tax free, guys. That's why I'm doing this. That's why I'm putting my family on this. And that's why this is a very important mission for me. Everyone should be able to have this in their life for themselves, for their family. This could be yours. So consider where you're putting your money, consider where you're parking your money. Are you being played by the system, or will you be using the system to your advantage? You can have this in your life. This is certainty. This is predictability. This is peace of mind. This is a lot of tax-free money you can have for retirement and for your family. And this is why the wealthy and the banks are using this. So if you'd like to learn more and see how this looks like in your life for yourself and for your family, you can go to my website using the link in the description. Fill out a Let's Connect form, and we'll be speaking shortly.